Hey everyone, welcome back to Corporate Decoder. Today we are looking at a report filled with exciting numbers and deep insights. Just kidding. It's a semi-annual shareholder report from Fidelity, so buckle up as we decode which advisor funds are hitting home runs and which might need a bit more time in the dugout. This report covers several Fidelity advisor funds, giving us a peek into their performance as of January 31, 2025. We're talking about funds focused on different sectors like consumer discretionary, industrials, healthcare, and technology. Let's start with the Fidelity Advisor Consumer Discretionary Fund. This fund invests in companies that sell non-essential goods and services, the kind of stuff people buy when they have some extra cash. For the Class A shares, the report estimates costs of $55 for every $10,000 invested over the last 6 months. This translates to an expense ratio or cost of 0.99%. Think of this as roughly $1 out of every 100 is going to fees. The fund holds 539,206,365 DAOs. That's over $500 million. Also, it has investments in 56 companies. The portfolio turnover is at 24%, so it's on the slower end, suggesting the fund isn't making huge changes to its investments frequently. The manager feels confident in the current investments. Most of this fund's money is in broadline retail like Amazon and specialty retail. Hotels, restaurants, and leisure also make up a big chunk, as do automobiles. These industries combined make up about 80% of the fund. Amazon is a big bet, making up nearly 25% of the fund's net assets, followed by Tesla at 16.2%. Next, we'll check out the Fidelity Advisor Industrials Fund. This one focuses on companies involved in things like aerospace, machinery, and construction. For the Class M shares, the cost is $65 per $10,000 investment with an expense ratio of 1.24%. This fund is managing 672,595. That's also more than $500 million. They've got investments in 56 companies. The portfolio turnover is a bit higher than the consumer discretionary fund at 31%. The manager is making some changes, but still being relatively passive. The top industries are aerospace and defense, which is nearly 25%, and machinery, which is 22.1%. The top holdings are GE Aerospace, GE Vernova, and Helmet Aerospace. Moving on to the Fidelity Advisor Healthcare Fund. This fund focuses on companies in the health industry like equipment, biotech, and pharmaceuticals. For Class I shares, the cost is much lower at $35 per $10,000 investment, leading to an expense ratio of 0.67%. This fund has a huge 4,187,363,357,000, about $4 billion, much bigger than the others. Also, it has investments in 116 companies, almost double the others. The portfolio turnover is 48%. That's more changes than the others, but also not too aggressive. Most of the fund's assets are in healthcare equipment and supplies, biotechnology, and healthcare providers. United Health Group and Boston Scientific are the top investments, but there are a few other recognizable companies. Now let's look at the Fidelity Advisor Biotechnology Fund. It focuses on companies in the biotech world. The Class I shares have costs of $34 per $10,000 invested with an expense ratio of 0.71%. The fund size is 1,535,128,600 and over $1 billion, and they hold 87 different companies. The portfolio turnover is 48%. This fund is pretty active, moving things around while still looking for long-term growth opportunities. This fund puts nearly all of its eggs in one basket. Biotechnology accounts for over 95% of the fund. The biggest holdings are in AbbVie, Regeneron Pharmaceuticals, and Amgen. That's over a third of the fund in just 3 companies. Next up is the Fidelity Advisor Utilities Fund. This fund focuses on utility companies providing essential services such as electricity and gas. Class I shares have costs of $38 per $10,000 investment, resulting in an expense ratio of 0.72%. The fund is at 1,133,336,068 in assets and holds investments in just 31 companies. The portfolio turnover is 82%, meaning the fund trades frequently, but it's also important to note that the turnover was not 82% for the 10-year historical number, it's closer to 40%. Electric utilities make up most of the fund at about 62%, and multi-utilities take up another 22%. The biggest investments are in NextEra Energy, Duke Energy, and Constellation Energy. Now let's decode the Fidelity Advisor Semiconductors Fund, which, as you might have guessed, invests in companies that make semiconductors. The Class I shares have costs of $35 per $10,000 invested, resulting in an expense ratio of 0.69%. The fund size is at 2,973,473,888 and it holds 49 companies. The portfolio turnover is 54%. The semiconductor industry changes so far, so this is an appropriate number. Semiconductors and equipment make up over 91% of this fund. The top holdings are in Nvidia, representing 20.3% of the portfolio, and Broadcom at 12.4%. These are household names in the AI industry right now. Next, we're checking out the Fidelity Advisor Real Estate Fund, investing in, unsurprisingly, real estate companies. The Class A shares have costs of $54 per $10,000 invested, resulting in an expense ratio of 1.05%. The fund is small compared to the others at 197,504,170 DAT and holds 34 companies. The portfolio turnover is 49%. This fund focuses on specialized REITs, residential REITs, and industrial REITs. The top holdings are in Equinix and Prologis, which are specialized REITs that support the tech industry with data centers and logistics. Finally, there's the Fidelity Advisor Energy Fund. This fund puts money into oil, gas, and other energy companies. Here, the Class C shares have costs of $84 per $10,000 invested, resulting in an expense ratio of 1.73%. The fund is pretty large at 1,104 Theria 16,824 and holds investments in 38 companies. The portfolio turnover is 15%. Here we have oil, gas, and consumable fuels taking a massive slice of the pie, nearly 84%, and then energy equipment and services coming in second. The single biggest bet is on ExxonMobil at over 24%, with Cheniere Energy and Chevron not too far behind. While that was a lot of numbers, these funds are heavily invested in a few sectors, meaning they could see big swings if those sectors do well or poorly. The technology fund with Nvidia and the energy fund with ExxonMobil depend a lot on the continued success of those stocks, and ultimately these reports tell us that some of the funds are doing pretty well thanks to the current market, particularly those in the technology and semiconductor sectors. Other funds are showing smaller gains and a few are facing challenges with a little bit of the usual fund shuffling along the way. You should look into if your particular fund is still a good fit for you. If you found this breakdown useful, don't forget to hit that like button, leave a comment, and subscribe for more deep dives into the world of corporate finance.